Well, Russia seems like the biggest risk to global financial stability right now, but it is not the only risk. There are many other things out there that you need to keep on your radar and that are probably not getting the attention they deserve. So let's give them some of that attention. Joining us now is Dr. Alexis Crow, global head of the geopolitical investing practice at PwC. Dr. Crow, great to have you back on. I mean, we're so focused on the pandemic and Russia, we forget there's other stuff. And you've got a great new report out on there, which is, number one, I think, is what you call the financialization of economies, private credit markets, debt. How big of a threat is that?
Thanks so much, Brian, for having me on. So certainly, I think when many are debating the pullback of the punch bowl and the eventual QT, there are some risks that have been rippling beneath the surface even prior to the pandemic. And one of those has been this explosive growth of the private credit market. So really this confluence of different factors, the one you mentioned on financialization of our economy, the value of stocks and bonds as a percentage of GDP in the US hitting 350%, ever rising, swelling number of market participants. And with investors, really in the hunt for yield, frothy valuations in the housing market and equity valuations, really coming into high yield debt. And where we have some concern is around the murkiness of some of the opacity of the funds managing this debt.
Yeah, what could happen? I mean, we know that the world has absorbed all this debt. I mean, the sort of the shadow banking market is probably as big globally as the sort of the unshadow or the regular, quote, banking market. What's the sort of the staircase down on this, Alexis? Worst case scenario, how does that play out?
Well, so certainly, I think what you reference as well is just this eclipsing of global assets under management of the shadow banks or the non-bank financial institutions vis-a-vis the banks since the great financial crisis. And that's certainly something that we've witnessed. Some of the Fed governors, some of the central banking authorities across the globe have mentioned a lack of transparency and raised concern and red flags over potential liquidity mismatches. So what we could see in a rate rise environment, in a potential earnings recession, et cetera, is a potential for redemption risk, a run on the bank activity with some of these open-ended funds. We witnessed that in the first few weeks of March of 2020 when the Fed stepped in and acted as a backstop and a buyer of the last resort to mitigate some of this action within the high yield fund. So some of the longer term shocks beyond that kind of bubble risk can also be related to propping up the zombie markets and the zombie economy. As much as 1/5 of the Eurozone corporate landscape can be zombie companies. What we also see is a social risk attributed to, central banks having to step in to address financial stability in the wake of excessive risk taking and diverting resources away from other potentially more productive parts of the real economy. That's certainly something that we see. And some industry bodies have highlighted the potential for those resources to be diverted to more productive parts of the economy.